Good evening, everybody. I hope you've all had a wonderful day. Welcome to our final Wednesday session of the year. So today we'll be focusing on fundamental analysis, and we'll be looking at how employment data affects the performance of currency pairs. So my name is Edwin, and I'll be running you through the session. So we'll start with the introduction. So employment data, as released by the officials of the central bank, it tends to measure the change in the number of employed people in an economy. So it basically tracks how many people were able to get jobs, either within a particular month, a particular quarter, or perhaps within the year. So a rise in this indicator tends to have a positive impact on consumer spending, since it tends to stimulate economic growth. So as more and more people continue to get job opportunities, their spending power also increases, so they tend to spend more. And so as they spend in buying goods and services, they tend to stimulate the economy. So factors that tend to affect employment and business environment will by extension impact economic growth and currency valuation. So basically, employment data has a ripple effect on the economy in the sense that if more people are earning, and if more people are earning a high salary, they tend to spend more into the economy. And as they spend more into the economy, they're basically boosting emergence of new businesses, or perhaps expansion of existing businesses and services. Given that that is the case, then you tend to notice that the economy would tend to be vibrant, or there's likely to be growth in the economy. So factors affecting employment and business environment will also by extension impact the economy. Again, if there's recession, in most cases, most people will tend to lose jobs. And if people lose jobs, then they'd have a low amount to spend, and obviously that will constrain the economy. Then we have some common terms in regards to employment data. So the first one is employment rate, and this is the ratio of the employed people to the total available labor force. So employment rate tends to give the percentage of the number of people who have been employed within a particular period relative to the total number of people who qualify to be employed. Then labor force is the sum of employed and unemployed persons. So labor force, or the total labor force, is the people who have qualifications to be employed but are not employed, as well as those people who are qualified and they already have jobs. Then unemployment is the state where an individual is actively searching for employment but cannot find work. Then an employment rate is a percentage of unemployed people relative to the available labor force in the economy. Then next, we'll move to how employment data is used in the analysis. So employment rate is essential because it has a ripple effect on consumer spending. So for instance, if the US consumer spending, the US consumer spending basically accounts for 70% of the total gross domestic product. So as I have mentioned earlier, this is a key data point that tends to affect the currency because based on the number of people who are employed, it will tend to help the economy to grow if more and more people are getting employed, and by extension, enabling productivity in the economy. And when the economy is productive, the currency will obviously tend to strengthen, and vice versa. A high unemployment, a high employment rate indicates that more people in the labor market have disposable income to spend in purchasing goods and services. So if more and more people are employed, then it's possible for them to have a spending power. So when consumer spending is increasing, businesses thrive, leading to better wages and even more job opportunities. So yeah, I've already explained that if people have the capacity to buy and sell goods and services, then there's a tendency that businesses will expand and more people will get jobs in the economy. When a sector thrives, it also indirectly supports dependent subsectors of the economy. So when a particular sector is thriving, you will notice that it will tend to support many other subsectors. So for example, if you take a company like Safaricom in Kenya, not only does it employ people within the organization, but it also supports other small businesses within the economy. So for example, if you take Safaricom agents, that is a very huge business because so many people have gotten employment, not within Safaricom, but within the economy, purely on the basis that M-Pesa supports agency model where people can be employed within the economy and not just within the telecommunication company. So that is an example of a case where you'd have a company within telecommunication sector supporting other subsidiary businesses around it. So the government also strives to ensure that there is low unemployment rate. So any government would want the economy to grow. So one of the ways to know whether the economy is growing is it can be measured based on the number of people who have been employed, because if more and more people are getting employed, then it means that the economy is performing well. The economy is thriving. So government would tend to support the economy in various ways, as we shall see going forward, as a way of enabling more and more employment opportunities to be created within the economy. So the government achieves this by providing support and incentives to the local businesses. So we shall have a look at how the government can help to spur the economy towards the end of this presentation. Then high unemployment rate is detrimental to the economy. So any government would want to achieve or would want to be in a position where it's able to incentivize various sectors in the economy to create more opportunities. So when there is high unemployment rate, as the case is in Kenya, you'll notice that the economy tends to perform dismally. As more people are unemployed, consumer spending tends to diminish. Again, if you have few people, or if you have less and less people getting into employment, or again, if the business sector is not performing quite well, if there's poor business environment, you'll notice that people will tend to shy away to spend. Besides that, it also weighs down on a few people who could be in productive employment or businesses, because they will tend to support many unemployed dependents. And this is more so in Africa. So we are more social, and you'll tend to notice that if one person is employed within the family, he will tend to support the whole family. So if few people are employed, then you'll notice that the few people who are employed will be weighed down because they're supporting many other people who are not in gainful employment. The few employed citizens may tend to feel less secure and cut down on spending habits in order to save for a rainy day. So that is the point. When you have few people employed, since they're supporting many people, or there could be many other people who are dependent on them, then in some cases they may tend to feel insecure because of their own safety first. So employment numbers and unemployment rates will therefore help traders to keep a pulse on the health of the economy. So employment can help the government or investors to know how the economy is performing. It is therefore imperative to ensure that employment rate is always high and does not drop. So any government would want to continue creating more and more gainful opportunities. Then the next thing is to look at some of the factors affecting unemployment. So the first one is government policy or government policies. So the employment rate significantly affects, the employment rates or the employment rate is significantly affected by government policies on higher education, taxation, incentives, and income support. So depending on the number of people who are educated, or depending on the literacy levels in the economy, the taxation policy that a particular government implements, again, the incentives that it extends to different sectors of the economy, all those things may tend to affect the rate of employment or the growth of the number of jobs. Then the other thing that can affect the employment rate is the seasonal employment fluctuations. So seasonal fluctuations in certain industries can affect the rate of employment. So for example, if you take agricultural sector or construction sector, certain jobs are seasonal depending on the demand of houses or buildings. Again, in respect to agriculture, seasons affect production. So when there is the number of people that might be employed in agricultural sector will depend on the the season, and the number of people who might be required to work, for example, in a plantation of a particular agricultural product. Then when it comes to technological advancements and automation, you'll notice that as we continue to advance technologically, this can affect the number of jobs that are created or the number of jobs that are lost. So, for example, certain industrial ventures previously requiring people to work, for example, on a factory line, may now not be able to employ people, but it can opt to use computerized machines, or it can also tend to use robots instead of human capital. Then the last thing is that literacy and high education can also affect the number of employment, the number of people who are to be employed, or the number of jobs. So when there's high literacy and education education levels, then there's a high likelihood that the human capital will be highly employable. So, for example, Kenya has high literacy rates, and that is why you'll tend to find that most people would migrate to other countries, and they'll be able to get gainful employment in other countries. And that is why you'll notice that one of the ways through which the economy is able to generate revenue is from the money that is repatriated back to the economy by the number of Kenyans who are working and living in other countries around the world. How then can you use employment data to trade currencies? So employment rates are coincident indicators that can predict or confirm oncoming recession or recovery periods. So depending on the number of jobs that are created, that can be indicative of whether the economy is likely to continue expanding or whether it's likely to contract. So employment data can be quite useful to indicate how the economy is likely to perform or how it might be performing at a particular point. So the onset of a recession is characterized by a massive unemployment rate or decreased employment numbers. So when there is a recession, or when the recession is looming, you'll notice that most people will tend to either lose jobs, or most companies within different sectors may be hiring less and less numbers. So employment data confirms whether the economy is growing or stagnating. During economic recovery periods, employment rate starts to rise back to its previous normal. So when there is recovery, or when there is a boom in the economy, you'll also tend to notice that more and more people might start to get employed, since most businesses will be expanding and they'd obviously require more people. So an increase in employment rate points towards a growing economy, and a high employment rate is obviously good for the GDP, or the gross domestic product, and by extension, the currency. So an increase or decrease in employment rate is suggestive of improving or deteriorating economy. So significant changes in the employment rate or unemployment rate tend to have considerable impact on market volatility. So you'll notice that when there's an expectation of the release of economic data relating to the number of jobs that have been created, depending on whether or not the jobs would increase, or perhaps whether jobs would decrease, then the variance in the number of jobs that are created may cause volatility in a currency. So we're going to have a look at one of the most recent announcements. So that was earlier this month on 8th. So it was on a Friday. And this was in relation to the non-farm payrolls. So non-farm payrolls tracks the number of jobs which have been created in the US. So I'll just share the chart to have a look at US crosses, US dollar crosses. But perhaps before I do that, we will get to see from the economic calendar the posting for the December numbers for the US economy. So this data is released on the first Friday of the month. But if the first Friday of the month happens to be the first day of the month, then the second Friday of the month is when you'd expect job data to be announced. So this was on 8th of December. So this data was posted at around 4:30 p.m. Kenyan time or East African time. So this is the data. So if you look at this data, you'll notice that it came out quite favorably. So the average hourly earnings month on month increased marginally from an expectation of 0.3% to 0.4%. Again, the number of people who got employment within that month or within the month of November increased. So the expectation was to have 180,000 jobs created, but it turned out that around 199,000 jobs were created in the month of November. And this is why we also had a marginal drop in the rate of unemployment. Since more people got jobs, and that is why we have a decline in the unemployment rate for that month. So all that data was quite favorable. So when there's a huge variance where you'd have quite a favorable data, more so where all data, because as you can see, all these three data points are linked. So when it turns out that you'd have a huge variance favoring the outcome in reference to the projection, you will notice that there's a high likelihood that the currency might strengthen against its peers. So in this case, we are dealing with the US dollar. So if you look at how US dollar pairs were performing at around 4:30 on 8th of December, you'll notice that this data caused a significant fluctuation in favor of the US dollar. So we'll now jump into the charts to have a look at a few USD pairs and how they performed during that particular time. So we'll start with Euro USD. So you'll notice towards 4:30 p.m. on 8th of December, Euro USD was performing pretty well in favor of the dollar. So this is the period when that or when those data points were announced. So you'll be able to see that there was a huge spike in favor of the dollar where Euro USD dropped by around 49 pips. USD JPY rose by around 95 pips. So if you're in a buy position at around 4:30, chances were high for you to make money during that time. Then GBP USD also had a significant drop by around 58 pips. USD CHF, there was a marginal rise by around 49 pips. USD CAD also rose by around 36 pips. So it wasn't much, but it was quite a rise. Then when you look at Aussie dollar, we had 37 pips. Then lastly, on New Zealand dollar, we had a drop by around 37 pips. The best pair to have traded would have been gold, because gold was able to drop by around 138 pips. And as you can see, from around 4:30 up to 7:15 p.m., that drop was sustained. And within that period, price dropped by around 330 pips. So if you're holding a sell position in gold from around 4:30 on that particular day, you could have had a significant drop in gold to capitalize on within 3 hours. So basically, the intention is to look for opportunities at the point when those data points are released. So sometimes it can be quite tricky to trade fundamentals. So one of the best ways is to set pending orders, so that depending on how the data turns out, you can have your orders triggered quite easily, as opposed to entering the market directly through market execution. So basically, that is how you can use employment data to trade. So we'll stop there. And I'd like to thank you all for the support that you've extended us for the whole year. And I hope you've been able to learn a lot through our sessions. So I wish you all a very pleasant festive season, and a new year. And I hope to meet you in the coming year. So see you all. and enjoy the rest of your evening.